Corporate finance practice problem using OneNote. MACRS Depreciation cash flow and net present value problem 1. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the practice problems down in the 1235 MACRS Depreciation cash flow and net present value Prob 1 tab. Also note, when using OneNote, take a look at the immersive reader. Our presentations up top will be mirrored down in the text area. Same name, same number, with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We're going to go through the calculations on down below. This will be more of a comprehensive problem, taking into consideration some of the components we saw in the past, then adding a new component, that being the depreciation, the MACRS depreciation calculation, the tax depreciation. So we have a similar scenario that we're going to imagine we put money down up front, that being the $900,000 cash flow out up front. Then we're going to get future flows in the future, which we're estimating to be years 1, 2, 3, and 4, 400,000, 300,000, 450,000, 500,000. And the tax rate is going to be 35%. The discount rate, which you might hear called the cost of capital, the required rate of return, the hurdle rate, is going to be 14%. Now, we're going to be putting this money down, however, more specifically than in prior presentations, on something that's going to be a depreciable type of asset, and more specifically than that, a 3 years MACRS fixed asset for tax depreciation purposes. Note, when we're thinking about depreciation, usually people think of an accrual type of thing if you're on an accounting background, whereas whether you paid cash or not for the equipment, you're going to put this on the books as an asset and then depreciate it, allocating the expense over the time period that it is used, rather than expensing it all up front, even if you paid cash for it up front. Now, that means that the depreciation is kind of on an accrual basis method, and when we think about these future purchase decisions, we typically are on a cash basis method because we want to be able to present value the cash flows. Therefore, if that was it, we would remove depreciation altogether. We wouldn't think about depreciation. We think about when the cash flows so that we can think about the cash flow. But for taxes, the depreciation is taxable. So note, tax depreciation, book depreciation are different. We want to calculate it for taxes because the depreciation will have an impact, and it could be a significant impact on the amount of taxes that we pay. So for taxes, we have to follow the tax code for depreciation. The general tax code for many of the fixed assets is what's called the MACRS depreciation. You're much more kind of forced to use a strict depreciation method on the tax code. You might have a little bit more leeway in financial accounting for like generally accepted accounting principles. For the tax code, you got to determine where your equipment falls, what type of equipment it is, and then depreciate it in accordance with that type of equipment. For taxes, usually we're trying to depreciate more in the front end than in the end, so that we can get a tax benefit sooner rather than later because of time value of money. So that'll be the general idea. Now, note that taxes could change over time. It's a projection into the future, so we might have to think whether or not the tax law is going to change. Oftentimes, the tax code will change in that they have a bigger, like, upfront deduction, like a special deduction or a 179 deduction, allowing you to depreciate more upfront. So those are all things you'd have to take into consideration. We're going to go over just the general concept of depreciation here for the standard MACRS depreciation, which is kind of like the baseline depreciation that has been for some time. And then we'll think about how that is calculated and then what the tax impact will be on it. That's kind of like be the new thing. So we've got the MACRS depreciation. Let's start off with that. Let's calculate the MACRS depreciation. Now, note that you could look at the IRS website, publication 946, which will look something like this, and you can read a lot more about depreciation and think about the depreciation calculation. If you go to table 1A in that publication, you can find it on IRS website, irs.gov, irs.gov, publication 946, table 1A. You got your lives over here. So we're talking about 3-year depreciation. You can use these percentages times the cost to figure out the amounts. Now, the depreciation, I believe it's useful for us to calculate it, though, because you might want to think about what they're actually doing. They're basically using a double declining half-year convention method with some alterations from that. So we'll do a calculation of it. It will be an estimate, only an estimate over here, but possibly an estimate that would be good enough for future estimate projection, and one that could give us an idea of what the actual calculation for MACRS is doing. So let's do our calculation. We're going to say year one, the cost was $900,000. That's how much we put down in cash, but we have to put it on the books as an asset and then depreciate it, which has a tax impact. Let's divide it by 3 years, which is what we're saying the life of it will be, at least for taxes. So the 900,000 divided by 3 would then give us the 300,000. If I compare the 300,000 to the cost, the 900,000, in other words, 900,000 divided by 3 gives us the 300,000. That would be the straight line dollar amount. Then I'm going to take that and divide it by the cost to get the straight line percent. So if I divide that by the 900,000, we have the 0.333 on forever. This is one of the things that will be estimated on the publication, because note here, it's not going to go on forever. It's just 33.33. So you have a rounding difference. If you did it in Excel, it would be 33.333 on forever, or 1/3, right? You can also do this by calculating the quick way, which is 1 divided by 3, 33.33%, and so on. Now, if we take that in times 2, multiply it times 2, we get the 66.67 on forever. This is rounded. This is actually 66.666666 on forever. That would be the double declining rate. That's why it's called double declining. It's going to be a front-loaded kind of depreciation method. If we take that times the 900,000, so the 0.666666 on forever, times the 900,000, we get this about 600,000. Now, then there's a half-year convention. So this would be it if it was for the full year. But even if you purchased it January 1st of the year, the tax code generally assumes it's purchased in the middle of the year. That's what's called the half-year convention. So we got to say, okay, I'm going to assume it was purchased in the middle of the year. There could be exceptions to that. If you try to purchase all of your equipment in December 31st, they might, there might be an exception there. But in general, divided by 2, the 600,000 divided by 2 gives you the 300,000. So year one is 300,000. Note that that happened to come out to be the same amount as the straight line method. So you might say, well, why don't you just stop here and stop all this other business down below? That's because in year 2, if you try to use the straight line method, it will be wrong. This is not the straight line method. It's the double declining method with a half-year convention. The half-year convention bringing the double declining back to the straight line method. Also note that we're basically going to have 4 years here because we're assuming we purchased this in the middle of the year. So we've got 2 whole years and kind of like 2 half years. Although year 4 will be calculated a little bit differently because it's kind of like a plug for the double declining balance. So if we then continue that on for year 2, we're going to keep this 66.67. That's the double declining rate. And then we're going to take then our 900,000 minus the last depreciation, 300,000. So kind of like the book value for tax purposes, which I know that sounds funny, but basically the asset minus the accumulated depreciation would be 600,000. 600,000 times 0.66666 on forever would be about the 400,000, about, rounding. Okay, so then if we take that, we have no 2 here to multiply because this is a full year. And then on year 3, we would take that 66.666 on forever. We were at before, cost minus accumulated depreciation, 600,000, minus the 400,000 we took in year 2, 400,000. That's going to give us 200,000 left times 0.6666667. That's going to give us about the 133,333. So that's going to be, we have no half-year convention here. That's a full year. Now, the double declining method for year 4 is usually like a plug. So that's basically the plug. And I know it's not a perfect system, right? Because we front-loaded everything. So that's what we need to be basically back in balance. So last time we left with the 200,000 minus the 133,333, and that would give us the 66,667. That's what we need for the final year. So over 4 years, even though it's 3-year property, due to the half-year convention, we have the 300,000 plus the 400,000 year 2 plus the 133,333 plus the 66,667 gives us the 900,000. In other words, the ending result here should add up to the cost of the equipment, because that, of course, means it's fully depreciated. We allocated the cost over the life, in this case, 3-year life with a half-year convention over 4 years for tax purposes. So that's the general rule. Again, you got the law will change. There's some exceptions. The tax depreciation is very complicated, but that's an idea. We have to take that into consideration when we take into consideration the future cash flows. So now we're going to think about what will our cash flow be, taking that depreciation into consideration and the tax impact. So if we look at our earnings before taxes for years 1, 2, 3, and 4, we're estimating $400,000, $300,000, $450,000, $500,000. So that's going to be our income before depreciation and taxes. Then we're going to add our depreciation. So we're just simply adding now the 300, the 400, the 133,333, and the 66.667 is here. That's going to be our depreciation for years 1, 2, 3, and 4. So if we subtract those out then, if I subtract those out, we're going to get then to year 1, 400 minus 300, 100. Year 2 is actually a negative, right? We got the 300,000 minus the depreciation. Now we have to assume that we're going to get a tax benefit from that, even though we have basically a loss here. So that's what we will assume. The 450 minus the 133 is the 316,667. The 500 minus the 6666 is the 433,333. So then we're going to take a look at the tax calculation on it. We're going to assume the tax rate of the 35%. Now, if we're talking about something that we're doing on the margin, that might be the last tax rate, because we're talking about a progressive tax system. So we're getting taxed at multiple rates. We might think of it as the last tax rate if we're being taxed on the margin, or it could be a little bit more complex than that if we have to take into consideration an average of some kind for the tax rate. So if it's the last thing that happened, we're making a decision on the margin, would basically be our last tax rate, meaning the next thing we're doing is taxed at the last dollar. So if we took that 100,000 times the 0.35, was it? 0.35, we get the 35,000. If we take the negative 100,000 times the 0.35, we get a $35,000 basically benefit from that. And then if we take then the 316,667 times 0.35, we get the 110,833, and so on and so forth. And then we have then the earnings after taxes, which would be calculated as the earnings before taxes, 100,000 minus the 35,000. This was a tax loss here, the negative 100,000, and then we got the 35,000, 65,000, and then the 316,667 minus the 110,833, and so on. And then we're going to add back the depreciation. So remember, the only reason we took the depreciation is because there's a tax benefit. Because really, we paid the cash up front. We already paid the cash, but we're going to get the tax deduction here. So that's what had the complication. So now I'm going to add back the depreciation so that when we think about this, we're really thinking about the tax or the cash method, the cash flows, because we can present value the cash flows. And the tax is a cash flow. Depreciation is not a cash flow. The depreciation is the allocation for tax purposes of the cash flow we put up front for the 900,000 piece of equipment. If we add back the depreciation, this line just mirroring this line up top, we've got the 65,000 plus the 300 is the 365, the 400 minus the 65, the 335, the 205,883, and the 133,333 is the 339,167, and so on. So now we have our cash flows. This is going to be our cash flow. So now you can imagine this being kind of like the starting point of our net present value type of problems, because now we have our cash flow, which we can now do our present value calculations on. And you can see how this would be applicable even with very complex projects. If you're projecting out into the future and you have a very complex cash flow system and you're kind of budgeting out into the future or making decisions, then you can have a very complex series of items here and get to the cash flow at the end of the day, at the end of the year, which we can then present value. Although these do assume that the cash flow happens at the end of the year. That's one of the limitations of our cash flow method. We're basically, when we pull everything back, we're assuming that they happen basically at the end of the year, whereas the cash flow in reality, if you have some kind of complex cash flow calculation, might have happened during the year. But keep that in mind. But you can see how now we can take these and we put these into our cash flow calculation. So we could do this horizontally or vertically. So we're used to seeing it kind of vertically down here. But note that if you were to do this calculation in a horizontal type of fashion, year 1, 2, 3, 4 up top, as opposed to the years on this axis, on the vertical axis, then you can imagine just continuing on down here and saying, okay, now I'm going to present value these using our present value or discount rate of the 14%. So let's look at that first, and then I'll look at it the way we've seen it before so we could see both sides of it. So net present value calculation is going to look something like this. Note that I put the numbers for the years up top. That's useful because that allows us to basically use our formulas to do the net present value calculation in Excel. So the cash, same cash, 365, the 335, the 339, the 348, that matches what we have here in our cash flow. That's our starting point for the present value calculation. And then if I did the present value calculation, let's do it this way, present value of the future cash flows. If we take this period 1 and present value it back, then we get to the 320,175. The calculation's down below. Now, note that if you want to look at multiple different ways to do this calculation, you can look at the prior section, you can do it with a formula, you can do it with tables, but because all these flows are different, it's very nice to use Excel or something like Excel on it. And even a test question would have to limit the amount of years if they force you to use tables. But if you want to look at multiple methods, you can look at a prior presentation. Present value, the rate is going to be that 14%. Remember that percent includes what we expect our gain to be. So if this calculation comes out to be anything above 0, it might be something we pick up. Note that it's an absolute reference by the dollar signs before the D, with the B and the 10, so that we can then copy it across. And then I'm going to say comma, number of periods. This is 1 period out, 1 year out. Note that I'm using this cell to note that instead of hard coding or typing in the number so that when I copy it across, it'll copy across. And then we've got the payment, comma, skipped, and the future value is that 365. So the 365 present valued back 1 year at 14% is 320,175. If I copy this formula to this cell, then the 335,000 present valued at 14% is 257,772. Formula is going to be the present value, same rate, 14%. That's the absolute reference. You can see here, comma, number of periods is now 2. You can see that cell changed here by the K to the L, moving to the right, comma, future value would then be the 335, present valuing it back. Year 3, the 339,167, present valued 3 years back with the rate of the 14% would be the 228,928, and year 4, the 348,333, discounted back at the 14% 4 periods is the 206,241. Adding this, and this gives us a total of 1,013,116. That does not take into consideration now our original investment, which we do not need to present value because it's at period 0. So I'm just going to add that here. That's the negative 900,000. So the 1,013,116 minus the 900 gives us the 113,116. So that's a positive number. Anything 0 and above would mean that we cleared the hurdle rate or the discount rate or the cost of capital, the required rate of return, whatever you want to call it, of 14%. So the fact that it's cleared it by a fairly good number is good, but anything that would be positive would mean that we might pick up the project. If we want to know actually what the return is on a percentage basis, we can calculate the IRR, the internal rate of return. Now, we might calculate the same thing using the kind of format we've seen in the past, meaning I might like to recalculate these, putting my periods here 0, 1, 2, 3, and 4, and then showing my cash flows this way, meaning 900,000. There's the 900,000 at period 0. There's period 1, 2, 3, and 4, the 365, the 335, and so on, 365, 335 listed this way, and have our numbers over to the left. This might look more familiar if you worked prior presentations, and then do our present values in this format. The 900,000 discounted back would be 900,000. I'm going to do the calculation here, though, because that'll make it easy for me to copy the cell down if we were to do this in Excel. So that would be negative present value. The rate would be that 14%, absolute reference, $ before the B and the 12, then comma, number of periods is now this 0. It's referencing this cell, however, as opposed to typing in or hard coding the 0 so that we can copy it down and the cells will move relative. Comma, comma, future value, the 900,000. We get that same number due to the fact that it's at period 0, time period 0. Then this amount, 1 year out, discounted 1 year, the 365,000 discounted at the rate of the 14% is 320,175. If I copied this formula down, it would be present value. The rate is the same, the 14%, because it's absolute here, comma, number of periods is now 1, and it was copied down, so you can see the cell reference moved down. And then we have comma, comma, and the future value, now cell reference moved down from 900 to this 365,000. If we do that on down, the 335,000 discounted 2 years back at the 14% is 257,772. The 339,167 discounted 3 year back at the 14% is 229,928. And the 348,333 discounted 4 years back at the 14% is 206,241. Adding these up, we get once again to the 113,116, matching what we got up here in like the horizontal method. Note that it's really useful to be able to see these calculations in this format and in this format, and to be able to see the present value calculations as someone might calculate it with a formula or using tables, so that, because you might think, well, I'll just learn how to do it one way and then I'll just do it my way every time, and that's fine. But if you're trying to work with somebody else and trying to see what they did, or trying to review their work, or trying to do something the way someone else is going to understand, so your supervisor knows what you're doing, then you have to do it the way they understand it, right? So it's really, and it helps you to understand if you can basically see these things and build these things in different formats, putting this on the horizontal axis versus the vertical axis, and doing the present values multiple different ways, and so on and so forth.